Today, we are honoured to be joined by American investor, founder, CEO and CIO of ARK Invest, Cathie Wood. ARK is famous for its investments in disruptive innovation and at its peak in Feb of 2021 had $50 billion in assets under management. Cathie, thank you so much for joining us on You're in Good Company.
Oh, thank you, Maddy and Sophie. I'm really happy to be here.
We
Love
are
Australia.
I know, we need you to come down and visit so we can meet you. But Cathie, we wanted to start off with just getting to know you a little bit, and I thought that this was a bit of an insight. If you could have dinner with anyone, who would it be and why?
Oh, that's so good. You know, it's interesting. Many people know us for our Tesla investment. And many people think Elon Musk and I talk all the time, but I don't on purpose. I don't because it's mostly for compliance, just to be, it's our largest position and so forth. But we have done a podcast with Elon, and during that podcast, I saw what a really nice, good, decent, he's a hard taskmaster, but he's a good person. And yeah, I would love to have dinner with him now that you've asked me. I mean, I hadn't thought about it.
What do you think you would ask him? What kind of conversation would you have?
My guess is we'd go all over the place because he is a Renaissance man, or in the US we would call him our Thomas Edison. So, the inventor of the century, I would say. So definitely talk a lot about that and the future and how he sees the future. But I would also like to get to know people and I know a lot from his book and his upbringing and everything. I just like to get to know the person a little bit better. I think I know him very well as a leader and a mover and a shaker, but yeah, just get to know him. And, he's got all these children, and how does he put his life together?
When does he sleep?
Well, I would love to be a fly on the wall of that dinner. But Cathie, on my recent trip to New York, I caught up with Lisa Diaz, who has been on our podcast before and who I know is a good friend of yours. And at the time, she spoke to me about how you were an inspiration to her for founding her own business, her own advisory firm in her 60s, at an age where, many people are starting to think about retiring and winding down their career. Meanwhile, the wonderful Lisa is ramping hers up. So you started ARK Invest in 2014 after more than 30 years in the industry. What was driving you when you did that?
Well, first of all, what was driving me was I was becoming such an odd duck in the industry, meaning after the tech and telecom bust in the early 2000s, and then even more so after 08, 09, I saw traditional asset management essentially going passive. Even active investors were starting to hug their benchmarks, getting very close to them because they thought the benchmarks against which they are measured would be the safe place to be. And this, I believe, has resulted in the most massive misallocation of capital in the history of mankind. It has prevented investment in innovation. Benchmarks are where they are because of what has happened historically. So the biggest stocks at the top, many people would call, do you know the expression FANGs?
Yeah.
So FANGs, many of those at the top are there because of their past successes. But Google, for example, is, we think, going to be disrupted mightily by ChatGPT. I don't know if you get frustrated doing searches, but I've always hated it on Google, but I use ChatGPT as long as it's about something historical. ChatGPT, it's amazing. It gets right to the point, gives me my answer exactly. And so, this could really hurt Google's entire business model. So again, that's an example of, here's this company sitting at the top of many of these indexes. We don't own it, because we're looking at the future saying, wow, that could be a problem. And the same thing happened around TikTok. We were looking at TikTok coming in and taking so much consumer mind share. They were saying, oh my gosh, what's happening to all of these other social media companies and their advertising dollars? TikTok, I think, quadrupled its advertising dollars, or maybe it was more than that in 1 year. Well, that came out of somebody else's hide. And so I felt, okay, we need to start a company. After I was being forced to say, oh no, you have to look more and more like this index. I was saying, no, I don't, because that's not what we do. And so I said, no, I have to do this because it doesn't exist out there anymore. No one's doing research only on innovation. They're not doing it rigorously if they are doing it the way we are. And we're using technology that has disrupted other industries. We give our research away. We're the first sharing economy company in the asset management space when it comes to research. We are disclosing our trades at the end of every day. Why? Because 08, 09, everyone lost trust in the financial system. So we said we need trust, and therefore we need transparency. And that's why we chose ETFs, exchange traded funds, because they are so transparent. So just, I was hoping with this business to start that pendulum shift back towards real research and real active portfolio management instead of just mimicking indexes.
Now, in Australia, like the number of funds that are run by like solo females or an all female led team is like stuck at this number of like 5%. How was your experience actually starting ARK after such a long time in the finance industry?
Yes. So, honestly, I knew I had to do this, and I knew that I was put on earth to do it. At least that was one of the reasons. Having 3 children was another, I must say, but a very important one. But I feel that everything I've done in my career up to now was in preparation for this moment. And now this moment has been 9 years, almost 10 years. And yet we've just gotten started. And how are we accepted? Actually, even today, the traditional asset management world thinks we're crazy. It thinks that we're taking wild risks because we're not paying attention to benchmarks. We don't care what's in benchmarks. We're looking to the future. And I don't think we're taking wild risks. In fact, I think staying in benchmarks is going to be much more dangerous, as the 5 innovation platforms around which we've centered our research. So multi-omics sequencing in the healthcare space, robotics, energy storage, artificial intelligence, blockchain technologies. Those 5 platforms involve 14 technologies that are going to disrupt the traditional world order entirely. So I actually don't think that's a safe place to be. And the people who have received us warmly are young people. Those who know that the ground is shifting underneath the world's feet thanks to technology, and they look at what's in benchmarks and they say, there's a lot more going on than that, and they're often out there innovating, and they know that based on our research, which we give them, we're helping them size the markets they're going after and figure out where the economics are going to be. And they want us to be right. So if they see us making a mistake in our research, because we give our research away not when it's finished, when it's evolving. We're putting all our charts up there. We'll get professors calling us or CEOs DMing us and saying, wait a minute, where'd you get that number? And that doesn't seem right. Well, they're battle testing our research. It is such a win-win for us. And so we're received very warmly by the innovation community as well. And I think, because of all of the media attention, there are people now that we have gone through two really difficult years, 21 and 22, we were the only ones out there fighting the good fight for innovation. And it became part of we certainly didn't intend it. We didn't intend to go through what we went through, which was a horror show for 2 years. We're coming out nicely now, but I think the increased media attention and they almost were, from the perception of others, not ours, beating us up when we were down on the ground. I think a lot of people rallied to us, to support us, because many in the world of investing, if you see something like that and everybody thinks that a strategy is wrong and these people are out to lunch, very often they're on to something big. So we're getting more supporters now for that reason. And we're also getting supporters, maybe they're not going to buy our funds, but they admire that we have the courage of our conviction, that we believe in our research, and we have the most amazing young team, and we want them, now that the markets have turned, I didn't want them going out into the battlefield to get shot by the media while we were having such difficult times. But now we're on the up and up, and they're going out there, and I think all of them will become famous during a much happier time.
You touched on some difficult times there, and after incredible returns over 2020 and 2021, ARK did experience some pretty significant losses. But how do you maintain strong conviction in that time, particularly when you are getting all of this doubt from the media and from others around you?
Yeah, it comes down to our research. No one is doing the research we're doing. And in the public equity markets, what we find is during risk-off periods where people are scared, their time horizons shrink to nothing. In other words, they just want to be with their benchmarks, and they're not really looking at the future of companies. We never lose our 5-year investment time horizon. And so what happens? If our research is right, and our price target is, X, and the stock price goes down, well, the percentage from where the stock has gone to where X is has just gone up. Now, we could be wrong in our research, but what happens during tough times is innovation actually gains traction. Better, cheaper, faster, more productive, more creative products and services. And heck, we look at what's going on with artificial intelligence right now. It's free. A lot of that's being commoditized. You don't pay you can pay something for GPT, but most people won't, especially young people won't, which is, I love that about young people. They'd much prefer to be in the sharing economy, and that's great for us.
Now, Cathie, you've been an inspiration for us for a while, a long time, ever since we started this podcast, and we are also young females in the finance industry. We want to know, what are important skills that you've fostered over your whole career and then also in your journey of founding a company that have really put you in good stead for being able to run and be a leader in that company, in ARK?
Yeah, again, I think the first thing that you have to provide, and I think you are providing it here, is a service where you are fulfilling an unmet need out there. So it's really starting, if you're going to start a business, you don't want to do a lot of me toos. You want to provide, in your case, a community with something that they don't have, or if it is out there, it's not as high quality as you think it would be. In our case, the unfilled need was people were beginning to ignore innovation, and we just thought that was wrong, and that the highest returns are going to come in innovation now that we're through this terrible, terrible period. The reason we went down as much as we did was interest rates going up as much as they did. We think that we're almost through. The Fed says 1 or 2 more. I don't know. I think they're done myself. But
Heard it here first.
I digress. So what else do you need as a leader? I think It's been interesting. I think you need a lot of experience, to be honest, in two ways. Here's how this world's doing something, and it's the old world, and yet I see another way of doing something, and that's where the bringing technology tools that have disrupted other industries, giving away research. That's considered crazy. Nobody understands that, and very few people are really doing it, except for a few promotions here and there. Engaging with the public as much as we are, becoming more open and transparent. That's what people want. And I think the other thing is a lot of portfolio managers. Now I'm speaking about our business in particular. They're not used to everyone looking at every trade and throwing darts at them for making mistakes. In the asset management industry, as a portfolio manager, if 60% of your trades are good trades, meaning they're right, that is an excellent record. Now, I would like to think in when we are judged by history, our long-term track record will be much better than that because we have concentrated strategies, and our research is so specific about who the winners are going to be. So I believe we have in our concentrated portfolios, some of the biggest winners that we're going to see during the next 5 to 10 years because of innovation. But I'm a portfolio manager who doesn't mind people kind of taking shots. I just don't care because, I have a different frame of reference. I have all of this research. I have these brilliant analysts, brilliant directors of research, brilliant chief futurists. And so I feel like we're armed with information and perspective that others don't have. And I think if a leader feels that, then what's the next thing you have to do? Then we have to, okay, this hybrid working model, how do we handle a lot of changes there? How to handle change? Nothing. Change is constant when you're running a company, and you just have to prioritize which of these are important, which are not. Delegate, and I'm a big delegate. Delegate as much as possible, and make sure that as the leader, you're the culture warrior, because every time you bring a new person into an organization, that person, this is a very negative way of thinking about it, but it's just the risk. I'm not saying this is what happened. The risk is that person becomes the cancer that enters the organization and proliferates from there. So I remember Sig Segalis, Chief Investment Officer from Jennison Associates. He just passed this year at the age of 88. He was my mentor and, taught me so many things. But he said that. He said, I hate it when we add another person because I know the chemistry could change completely. This could be the cancer. I have a more optimistic way of thinking about adding people, especially because we add people with domain expertise, often fresh from college. So they have one foot in the new world, and they're increasingly now becoming Gen Zs. And so we need more of those because guess what? They're defining, and you're in that category, I think, they're defining how the world's going to work. So I love it to bring new blood in and actually empower them and make them accountable because I see massive creativity and energy coming from these young people who feel like we are on a mission to transform the financial services industry. And I do think we're back to meeting an unfilled need. I think employees in an organization need to feel a mission and need to believe that their leader is serious about that mission and will not pivot. And, in small businesses, you have to pivot, but not on the mission,
Oh.
Tactically, you pivot, but not on the mission. And I'll just tell one quick story there. One of the first analysts we hired, he was at Stanford University, and I had identified him through the parent of a friend of mine who made the introduction. But I met him and I thought, he's the kind of person I would like as an analyst. And this, so he would have been 23 at the time, I think. He told me there were 3 reasons he would never join ARK. The first is he was a surfer from Hawaii, and he could never work in front of a computer all day long. The second was we were in New York City at the time, and he would never move to New York City. And then the third is we were in the financial services industry, and that was the dark side of the world, and he would never. So those were the 3 dings. And I said to him, as soon as he said that, and I said, then you have to come, because we are going to change the financial world. We're going to change it. And he didn't come right away. He took 11 months of soul searching and then called me up and said, is the job still there for me? And I said, yes. And he went on to be, he was our first crypto analyst, and he had the fastest learning curve I've ever witnessed. And he ended up starting his own venture firm in crypto, which we weren't doing at the time, at least investing. And we invested in his company. And he still has shares in ARK.
Very cool.
That's an amazing story.
Yeah.
We have touched on ARK's research a couple of times throughout this episode, and one of the things that Soph and I have been spending a lot of time reading recently, and we're massive fans of, is the Big Ideas Report. And in this report, which is incredible, we'll make sure we put a link in our show notes so that everyone can go and have a read. You talk about how the fastest growing technology, you believe, is neural networks. In fact, the report actually states that neural networks should prove more momentous than the introduction of the internet, which for, I think, probably our generation means a lot, because we know how that has shaped sort of how we go about our lives today. So first of all, because I suspect that this may be a new concept to many of our listeners, would you mind quickly explaining what neural networks are and then why you believe this is the fastest growing technology?
Sure. So artificial intelligence involving neural networks, we believe is going to be the biggest catalyst to innovation in history, and especially now. So if you go through Big Ideas, you'll see how we think it's going to become the biggest catalyst, how many other of the technologies it's going to activate and bring to life. Neural networks are patterned after the brain. And so we are aiming out there for artificial general intelligence, machines, outwitting man maybe. But right now, we like to think about what's going on as augmented intelligence. This is going to lift us all up and make us all very productive, much more productive. So globally, throughout the world, there are $32 trillion paid to knowledge workers. And we believe that the next big wave of automation, which is artificial intelligence, is going to take away those very boring, mundane, tedious jobs. Pick and pack. But even that's on the light manufacturing side. But on the knowledge worker side, the time to write grants here in universities, it can take months, 3 months to write a grant for government funding. We are finding that with neural networks, artificial intelligence, that time collapses to potentially a few hours.
Wow.
Think about that, 3 months to a few hours. Anything that is rules-based, and neural networks are powered by algorithms. And algorithms are rules-based, right? So any knowledge work that's rules-based, meaning probably mundane, boring, paperwork.
Our jobs in accounting.
Legal is, but again, it's going to it'll displace a lot of paralegals. But to the extent people go to law school and enter the field, the job's going to be a lot more interesting because machines are going to handle the boring parts of the job. And that is going to allow us to leverage our intellect and creativity, depending on what the job is, to advance the field even more. So we think that this moment is the equivalent of the assembly line entering into the manufacturing space, the first automobiles. And that transformed, that created that really cemented the Industrial Revolution. And we believe this will be a knowledge worker revolution, or a knowledge revolution would probably be the better way of saying it, and give people much more interesting jobs. Many people worry about the impact on employment, the combination of robots and artificial intelligence, and that's a convergence of two technologies too. And we're not really worried about that. We do know there will be retraining, there will be some displacement, but the history of technology is it is a net job creator. We just don't know what those jobs are going to be. And an example of that from the internet age is in the early 90s, I can tell you, we never, ever thought of Uber. That never crossed our minds. But Uber and Lyft could not exist without the internet, of course. And we're going to find many more jobs like that, probably more gig economy jobs where people can determine what they want to do, when they want to do it, and how they want to do it. So it's going to give us a lot more freedom, I think, and I think it's pretty exciting.
So this is an interesting one because, as Maddy said, we obviously we're in accounting roles. And, I've got a lot of friends that are kind of in that knowledge worker space. What do you think young Australians should be looking at to upskill? Because, I feel like we're really at this moment, we're at a moment where we're looking at AI being like, how can we adopt this into our lives? How can we upskill? How can we learn? What are some of the skills do you think that we should be looking to upskill in to be on that kind of positive side of AI adoption?
I'm going to point them to Big Ideas 2023, and our Big Ideas, we started it in 2017, and you can see the evolution if you go back, how much closer to the mark we were on electric vehicles, and now we're talking about autonomous. So I believe that we have set up our portfolios on what I call the right side of change. So when I am speaking with young people, I suggest they look at our research, think about it in the context of their own education, but also keep learning. Do not stop. What's happening right now is the change is coming at us so quickly that it's going to be easy to be on the wrong side of change. So I know the younger generation is great with podcasts. We do a weekly podcast. It's all about innovation. Again, making sure people are on the right side of change. Big ideas, making sure you're on the right side of change. To give you an example, what we used to call bad ideas as opposed to big ideas we did a report about it, and if you look at what's going to be displaced, that's as important as understanding what's going to displace it. So I know that energy is important in an important industry. We really believe that oil demand is going to fall if we're right on electric and autonomous. Right now, the consumption in terms of millions of barrels of oil per day is about 100 million. And we think by 2030, I think it is, or maybe it's 35, that will go down to 70 million. Mm-hmm. And what that means is that the world we've lived in, which was built on top of oil, effectively, the industrial part of it, certainly, transportation and so forth, that's going to transform completely. And you really want to stay away from industries that are going to die, because they're going to pull back on investment, it'll be one layoff after another, or it'll be one transformation after another. Many oil companies are trying to transition into renewables. They have the same problem that traditional auto manufacturers have. 95% of their business is based on the old world, and 5% is on the new world. Well, guess what? That company is going to have many more headwinds. So I like to focus more on pure plays, not so much transitioning, even though, God bless them, we want them to transition. But if I'm looking for a career, I want pure play so I can just go with the new, the new way of doing things. And I also want to, again, using your education, I want to make sure that I have an important place in that firm and cannot be displaced. And a lot of that will be, if you're talking about accounting. So sure, there's a lot of rules-based, the rules are in accounting. But when you get into higher level of accounting and you get into tax, let's say tax accounting, sure, there are a lot of rules, but there are a lot of creative things you can do to change a company's tax situation, and they're global in scope. So just think about the value you add if you cut a tax bill legitimately by being creative with your tax accounting skills. So I think even if you're in an industry, and the knowledge industry is going to be disrupted, look at what the highest paid people in the industry are doing now, and you will probably find that in the future that's going to be turbocharged, and learn from them. One other thing that I suggest is, if you see something in, let's say, Big Ideas or from our podcasts, you can go to our analysts' Twitter site. All of us are on Twitter. You can go to Twitter and follow them, and you'll be keeping up with the change, all right. But also, if you're interested, deeply interested, and want to learn and educate yourself, start following who they follow. And we've spent nearly 10 years figuring out who are the right people to follow in different categories. And I do believe that we're going to be doing a lot more self-education, and that those who become passionate about, some facet of innovation and just know so much about it. Doesn't matter if you're in the financial field, but you know more about that. You'll be thinking about it from the financial angle, and bringing much more creativity to the process than otherwise would be the case. If you didn't know anything about the technology, you might not be able to help as they're trying to gain efficiencies as they follow a learning curve, which is something that happens in technology. Costs fall over time. That should pass through into pricing. And you should think about the world in that way, not the inflationary way. Any company really depending on pricing, we think in the future, is going to have problems.
I think one of the coolest things about society today and the world in which we live in is that information is so accessible. And, you touched on then following people on Twitter and then following who they follow. And I think whenever you are interested in a certain theme or a certain topic, it is so easy to go and educate yourself. And that is such a cool thing to be able to do and to be empowered to be able to do.
And I think, what ChatGPT is going to become, or how it's going to evolve, it's going to become our own little tutor. We have our personalized tutor walking around with us, right?
So true.
And that's exactly how we should think about it, and actually use it in our jobs.
You touched on oil in there, and I wanted to chat a little bit more about that, because retail investors at the moment really are pouring into ESG-related funds, and ARK doesn't have a specific ESG fund. Can you tell us a little bit more about why that is? I imagine it's probably quite an active decision.
Yeah, it is. And in fact, here in the United States, you may not know this, but ESG has become very controversial because there's so much greenwashing going on out there. Yeah. Maybe the same is true in Australia. So there are two reasons. One, innovation is organically or intrinsically ESG. And when we started ARK, I started watching other fund groups, knowing that ESG was becoming so important, slapping ESG on their fund names. And I called it putting lipstick on a pig. And I just was not going to do that. And because I didn't want to do it, because I truly believe we are organically and intrinsically ESG. And in fact, our scoring system incorporates, in the first, so we have a 6-point scoring system after we've done our top-down and bottom-up modeling. The first one is people, management, and culture. Elon Musk is trying to save humanity from itself, right? That's why he started the company. He wants that oil consumption to go down and wants to improve the environment. That is what I mean by organically and intrinsically. Now, if you can believe this, in the United States, the S&P ESG fund, I believe it was that one, basically kicked Tesla out.
I was about to ask you about this.
Yeah.
Come on, you have got to be.
Well, I guess because it meets the E, and then I think there were questions about the S and G, right? That was the reasoning behind that decision.
It makes it on the E, but not on the S and the G. So many times that, and I didn't read why it did that. I think a lot of this is, but many times in innovation, what you find is the founder needs to lead the firm until it hits escape velocity. Otherwise, they lose the mission and the purpose as you bring people in from the old world. Who's he going to bring in? Someone from GM or, that wouldn't quite work. So you find that a lot. And then, every company has controversies. It's just Tesla is such good clickbait that
so
S&P
true.
reads more about Tesla's controversies, their allegations of racial discrimination. I have been to their plants, and I'll tell you, before any of this ever made the news, and I watch out when I go to a plant, how happy are these people? And, how mission-driven are they themselves? That's what I found. That's what I found there. And, you can go to probably every company in the United States, and there's going to be some racial discrimination suit somewhere. It's just the nature of the animal. It's become an epidemic in terms of ambulance chasers. This is how lawyers can make some big money, right? Especially if they get class action suits. So consider the backdrop there. And governance, social and governance is tied in. I think I've covered both of them. So, if they want to kick it out, fine. It'll be less competition for us.
So we've touched on Tesla a little bit, which is one that you've spoken about quite openly in terms of you saying that you think it's going to be one of the biggest AI plays that, fold out over the next couple of years. And we've touched on AI a little bit, and I think it's definitely on the tip of everyone's tongues of, where should I be investing at a time like this? We saw, for example, obviously the results of NVIDIA that made a jump for an Australian retailer, what do you call it? A furniture retailer, forgot the word. Their shares jumped by 25% after the NVIDIA jump because they said that they were using, ChatGPT or those types of services in their customer online queries. And so where do we think, as young retail investors, should we be putting our money, or where do we think significant opportunity is going to occur?
Yeah, it was interesting. We got a lot of press again for NVIDIA because the press loves to criticize.
Yeah.
So we own NVIDIA in most of our specialty funds, but we've been taking it down for quite a while because its valuation skyrocketed relative to the other AI plays that we think are pretty profound. NVIDIA is doing astonishing things. We got in at $5. It was a $5 to $10 billion market cap in 2014, and we've ridden it all the way up in most of the funds. We took it out of flagship because flagship's very concentrated, and we see many other much less expensive AI plays. it still meets our 15% compound annual rate of return expectation, but barely. Whereas these others are, now, again, our research could be wrong. I always have to say that for compliance, but, these other names we think are 40, 50% compound annual rate of, because they've been killed as NVIDIA's gone up. Doesn't make any sense to us. To give you an example, Tesla. So NVIDIA is at 25 times sales, not earnings,
Wow.
sales. Okay? Tesla is at 6 times sales.
Wow.
Twilio, many people don't know the name, is at 2 times sales. Twilio, in terms of data, the most important competitive advantage, once you've got a visionary leader, AI expertise, and domain expertise, is proprietary data. And so you'll see every company in our portfolio is there, at least in part, with an AI angle in mind. It is their data.
Proprietary data is the new oil.
Yeah, there you go. So that's right, and it's becoming even more true. That has been a saying for a little while, but it's ever more true now. So Tesla has more miles of real-world driving data than all of the auto companies and tech companies going after transportation in the world put together.
Wow.
And probably orders of magnitude more. And that's because it has 4 million plus robots roaming around the world. I have 2 of them, a Model 3 and a Model Y. And they're collecting data every day, sending it back to Tesla saying, okay, here's a disengagement, something didn't go right, let's study that. And, they're using AI in a profound way that is going to create autonomous driving. And they're going to launch nationally, we believe, here in the United States, whereas most others are going city by city. Tesla thinks big. It's already mapped this out. And we believe that it will be the biggest beneficiary in the next 5 years, 5 to 10 years, from autonomous driving. Autonomous driving revenues today are basically nothing. We believe by 2030 there'll be $8 to $10 trillion globally, which, if you want to size that, the U.S. economy is roughly, it's approaching $25 trillion. So we think this alone is going to be a $10 trillion global opportunity by 2030. And Tesla is leading that charge. We think Tesla certainly is in the U.S. China won't let Tesla lead that charge. It'll be some other company, but we can't identify it yet. That's how far behind most companies are. And then we have other companies in the healthcare space. Exact Sciences. You may know. Do you know Cologuard? Cologuard advertised in Australia.
Mm.
Well, it is a test for colorectal cancer, and it's a fecal test, so you have to send it in, and it's kind of disgusting. But it's turning to a liquid biopsy. It'll be a blood test, so you'll have to go to the doctors for that. But just with a blood test, doctors will be able to tell whether you are in the early stage of many cancers, including colorectal cancer. So we think there will be a time where, unless you're just very high risk, we won't need to do colonoscopies. In the United States, when you turn 40, you go for a colonoscopy every 5 years, and the government will or insurance companies will reimburse. And it's reaching down earlier and earlier into years. That's how powerful these tests are becoming. They can detect at the earliest stages of cancer. Well, wouldn't we like the company that's able to detect every stage of cancer in stage 1 or before stage 1, just learning how the genome is setting up for cancer? Yes, we would. This is going to be a winner-take-most opportunity as well. And we think Exact Sciences and Freenome, which we own in our public-private crossover fund, that they are in the running as Invitae. Really, I think Exact is probably also 6 or 7 times revenues, not 25 times revenues. And these are huge, very high value add opportunities. The other thing that people don't understand is it's not like NVIDIA is not going to have any competition. In fact, it didn't have any competition, really. Now everybody's onto the plot, and Tesla has pulled out NVIDIA from its cars. It has its own AI chip. Google has its own AI chip. Meta has its own AI chip. They're not in production, but they will be. So these hyperscalers understand how important this is. They have the money. Amazon's going to have its own chip and service. So I think everyone's thinking about NVIDIA at a moment in time, and they forget, when you see this kind of success, it invites competition.
I love that you mentioned the Meta thing and then also linking with the transparency of ARK, because yesterday in the AFR, which is a big publication in Australia, is just number one headline, like, ARK buys into Meta.
Oh, it's so interesting. We own that in the specialty funds as well. And we added to it in the specialty funds when it had been creamed. We didn't own it. We didn't put it in the flagship because Mark had not pivoted from his obsession with metaverse to AI. That in the last call. So the reason it's another one. Oh, did that one too? No, we're like for like. Tesla's dramatically here. Meta, Tesla goes to 12.5% of our portfolio. We can't keep, and now I'm not saying that's where it has to stop, because I can't tell you that from a compliance point of view, but any prudent portfolio manager won't let a stock go to 25, 30% of the portfolio. That's not considered prudent portfolio management.
So, interestingly, you've been speaking about multiples on sales rather than potentially the bottom line with earnings. And I think with a lot of companies that we look at, specifically kind of in the startup space or, that are in that innovation space, they might actually they might not have those bottom line earnings because they're reinvesting or whatever else. But I think that's something as a retail investor I struggle with, because I think I want to be investing in a profitable company, but then I love the mission or the vision of the company that maybe isn't making money just yet. So how do you differentiate a good company from maybe a fad?
Yeah, and that is also a great question. We are very focused on starting with our top-down research, trying to figure out, okay, how is this going to work, right? How is this going to work? So to give you an example here, in autonomous driving, in 2014, we asked the question, okay, Tasha Keeney, go out what autonomous vehicle is. Like, how is this to be possible? And so she started doing research on it and posting research, and was starting to get incoming DMs from CEOs who were involved in autonomous. And she learned a lot. And one of the things she learned pretty quickly was that the brains of an autonomous vehicle, or the central nervous system of an autonomous vehicle, were going to be GPUs. Now, I remember sitting in on that brainstorm when she said that. And it's only because she was talking to these people. We didn't know this. And we owned NVIDIA at the time for its gaming. It was a PC gaming chip company. That's all it was. And I said, Tasha, nobody knows that. I mean, that's crazy. PCs were dropping at a double-digit rate. NVIDIA was getting destroyed. It dropped into that $5 to $10 billion range. And we bought it all the way up. It became one of the top positions in many of our portfolios. And when I say specialty portfolios, it's even in our genomics portfolio, because that is probably the most underappreciated space for the impact of artificial intelligence. As I mentioned before, we think that the convergence between DNA sequencing and artificial intelligence is going to help doctors identify cancer, certainly in stage 1, even pancreatic cancer, but it may be even before stage 1. That's brilliant. But you don't see AI focused much in healthcare portfolios. Well, it is in ours, and one of the ways is NVIDIA. And we make sure that all of our companies are harnessing AI as they're doing their research and working with partners in the AI field. So that's how we come across companies. Now, that particular one was profitable at the time. Your original question was, how do you find these companies, yet they're unprofitable, so how can you bet on them? And so what we're doing is we're using a scoring system. And that scoring system involves, first, people management and culture. First, like top priority. Is this a visionary management team that understands how the future is going to work and is going to be the reason it's going to happen, right? 2, do they have barriers to entry that no one else has? So I can use Tesla, if you don't mind, as this example, just so you understand how in 2014 we were able to put a Tesla in the portfolio, no problem. It was losing gobs of money. We saw 4 barriers to entry that Tesla had that no one else had. One was battery technology. It was writing down a different cost curve from every other auto manufacturer, and we pay attention to these learning curves. It was using the consumer electronics batteries, so laptops, cell phones, and all of these other auto manufacturers were laughing at them, and so were auto analysts laughing at them, saying, "Oh, that's great. These batteries are blowing up on the Boeings, and they've been banned from Boeing, and he's gonna line the bottom of a car with these batteries." Sounded crazy. It was seemingly an impossible engineering feat, but he did it, and we knew he was doing it. So battery technology, they're still 3 years ahead of anybody in terms of the cost declines. 2, the only auto company to build its own chip, design its own chip. Just like Apple did in cell phones, and Apple stole the market from Nokia, Motorola, Ericsson, and BlackBerry. It was thinking differently, or it said, think different. And I said, that's not good grammar. It was thinking differently. And Steve Jobs was think different. Critically, as I mentioned before, proprietary data, more than anyone else by orders of magnitude. And then finally, over-the-air software updates that could correct the performance of the car, something going wrong. 4 barriers back then. Nobody else had. And as we interviewed other companies, we knew they weren't even close. They weren't even thinking about it. And so, that gave us great confidence. So that's the second. Product and service leadership, that's market share. You can follow that. And it's been obvious how Tesla's been doing. Execution, are they spending enough money on R&D as a % of sales? And if they are they spending it in the right places? So we're very focused on that. Valuation. Many people don't think we're focused on valuation because of how you asked the question. That is not true at all. In order for a stock to get into our portfolios, we have to believe that in the next 5 years, it will deliver a compound annual rate of return of 15%. And that is only if its multiple goes down to something close to the market multiple in terms of enterprise value to EBITDA. So over 5 years, most of our companies are facing a pretty significant valuation headwind, and they have to make it up with revenue growth and margin expansion. And we have to believe that is indeed what they're going to do. And then the last score is thesis risk. Okay, what could knock this scenario off? Government regulation, regulation is always a big one, as is another technology? Is there another technology coming through the pipeline? A lot of people ask us about the different kinds of batteries out there. I think we've learned over the last few years that any founder of a company in the battery world who wants to scale is going to present the opportunity to Tesla before anybody else, right? So we get that question a lot. On the regulation, let's use Tesla again. Many people say, the government's never going to allow autonomous driving. That's going to kill people. No, what they forget is 85 to 90% of all accidents out there are caused by human error. And so the big one out there, the ethical case is, wait a minute, the autonomous vehicle has to make a choice between a mother and walking the baby carriage across the street or a telephone pole that they're going to, those are the two choices. Do I kill this or that? It's just the wrong way of thinking about it, that's an impossible situation for a human being too, so but autonomous and the National Transportation Safety Association here in the United States has actually documented from fatal Tesla accidents. Now there are 45,000 accidents per year in the United States. It is only Teslas that get the headlines, right? You hear Tesla,
Yeah.
Tesla, but that's crazy. None of the other but after going through and analyzing those fatal accidents, the National Highway and Safety Transportation Association has concluded that, and this was 4 years ago, that anyone driving in a Tesla car that has some of these safety features that we now associate with full self-driving is 40% safer than any
Wow.
other car. Yeah, and that was back then, and they've gotten a lot better.
So, Cathie, unfortunately, we are starting to run out of time, but it would be remiss of us not to quickly touch on Bitcoin, which seems to be at a bit of a crossroads at the moment. We had the banking system failures in March of this year, which really paved the way for the utility of Bitcoin, and yet recently we've seen the SEC suing Coinbase amidst really strong advocacy for greater regulation in the US. What is your elevator pitch for Bitcoin? Why do you believe that Bitcoin will reach the price target of 1.5 million?
Well, Bitcoin epitomizes an anti-fragile asset, which means that you can throw everything you want at it, including Chairman Gary Gensler, and it will thrive, ultimately. And in fact, I just had a fascinating discussion with the former surfer analyst, first crypto analyst at ARK, who started the company today, and his partner, and they raised a very good point. This is great for the distribution of wealth throughout the world. The SEC is pushing innovation out of the United States and into other countries in the world. Now, Winston Churchill said, I'm paraphrasing, at some point in time, the United States makes every mistake in the book that is possible before it gets it right. And that's what we're doing here, and we're getting this all wrong, and it's terribly political, and yet the checks and balances in the United States, so executive branch, so Gensler appointed by the president, judicial branch, and legislative branch. The judicial branch is weighing in against the SEC, one court case after a time. The legislative branch is on the march. This is going to become, in fact, one of the partners of this new company, he said, you'll be very happy to know that I have converted from the Democratic Party to the Republican Party. And I couldn't believe it. I mean, these guys are so liberal. I said, really? He said, yep, one issue election for me. Because the Republicans are pro, because it's crazy. And the Democrats, innovation shouldn't be a partisan issue. So what is my elevator pitch for Bitcoin in particular? Every word I'm about to say is important. Bitcoin is the first. Global, that's really important. Private, no government oversight. Digital, rules-based monetary system in the world. That's a big idea. That's a very big idea. And in fact, so big that when we wrote our first white paper on Bitcoin in 2015, I asked my mentor and dear friend, Art Laffer, he's a famous economist, Laffer curve fame if you've taken economics. I asked him if he would read and critique the report, and if he liked it, would he put his name on it as a collaborator. And he certainly critiqued it and tore it up, put it in two, said, I will put my name to this, I won't put my name to the technology, and I don't understand the technology, but I'll put my name to the economics. And he said, this is what I have been waiting for since we went off the gold exchange standard in 1971. This is a rules-based monetary system, but it's even better. It's global. This could really do wonders, especially for emerging markets that are plagued with hyperinflation and corrupt fiscal and monetary policies. It could transform the world. It is a very big idea. And we do believe in our, right now, the 2027 cases, base case is 627,000. I think it's at 25,000 now. And our bull case is 1.3 or 1.4 million. And you can see in big ideas, if you go in there, our assumptions. How do we tell you exactly how we get there. And, you know, my confidence has never been higher, because this is the ultimate battle test. You think a government is going to, the government of the largest country in the world is going to ban something. Oh, no. No. It's this is a very big deal. And, you know, I actually did a podcast with Art Laffer. You can find it during the regional bank crisis, when Bitcoin, as you said, and thank you, most people don't understand it the way you described it. Bitcoin went from 19,000 to nearly 30,000 because it was a flight to safety. And I think all innovation will be a flight to safety phenomenon, whether it's your jobs or your investment portfolios. So, you know, as I always say, just get on the right side of change and stay there, which means you're lifelong learning.
Well, Cathie, we could honestly speak to you all day long about this kind of stuff. And I think we will share the Big Ideas report. I'm sure a lot of listeners probably have already read it, but it's one of those things that when you do start reading it, you get really engaged and excited and find things that you are passionate about. But to close out this interview, we would love to ask you, knowing what you know now, if you could go back to your 20s, and I'd like to clarify, by the way, we're on the verge here of millennial. We are not Gen Z, but we are like just 1 year off it, so we're actually close.
You're my son's age then. You're my son's age, yes.
How would you, knowing what you know now, manage your money?
Knowing what I know now, I mean, I must say, I think the most important thing, so that you don't become emotional about it, because that's the worst thing. I was not emotional. I was actually had courage of conviction, because Art Laffer educated me. So I thought I knew. So I bought 20-year zero coupon bonds even though I was working in the equity markets in 1981. And, you know, they have to be some of the best investments ever. But people thought it was crazy. No coupon and just pure price, whatever. So I think the most important thing is develop an understanding, an interest in an area. Develops, you know, it may even be tangential to your own career. Just something that you bring that keeps your confidence. You develop the people you trust around you. They're going about doing the research in the right way. You keep listening to what they're doing. And I find the worst thing over the years that I have seen, and it upsets me so much because it hurts so many people, is the emotional decisions, selling at the low in 0809, destroy years and years and years of wealth accumulation. And so it is not to invest so much that you have to sell if we get into a really bad environment. So keep some cash. But if you do invest, especially in a strategy like ours, some people say treat it like play money. I don't say it that way because I so believe in what we're doing, but it is very volatile and you can't look at it. And that's the other thing. If you're in a long-term oriented strategy, then don't look at it on a day-to-day basis, because again, that stirs emotion. So I think that's just keeping an even keel, trust the people you're investing with, make sure they know what make sure their research is excellent. And if you have some expertise yourself, test them with it. And it'll help your own confidence when you go through bad times that, yeah, they've got it, I've tested them.
Well, Cathie, thank you so much for your time. It has been an absolute pleasure, and we are so happy to have had you on You're in Good Company.
Oh, thank you. Thank you, Maddy and Sophie. This was a great interview. I'm so happy you're educating your community because it is so important, and I hope they've learned a thing or two.
I'm sure they will have learned a lot from today, so thank you.